Hi, this is Ian Coleman, and this is the video analysis for the FX majors and the dollar index going into the week 14th of January. We're going to break down the time frames, looking at the higher time frames all the way down, possibly into intraday charts, highlighting support and resistance levels and chart formations, and our bespoke support and resistance, highlighting what we're looking at this week. Now, pretty slim docket, if you like, for data releases on Monday, but then Tuesday we've got the much anticipated UK parliamentary vote on Brexit. We're expecting obviously high volatility in sterling crosses. Tuesday we've also got ECB Draghi speaking in the afternoon. Then on Wednesday we've got consumer prices for the Eurozone. And then at 9:30 UK time, the sterling or UK CPI figures. We've also got some dollar figures, the retail sales on the same day. Going into Thursday, European CPI figures, and then Friday is the Bank of Canada Consumer Price Index. So there's a fair bit to look at this week. Like I said, we're going to break down, first of all, looking at the dollar index. Now, the weekly chart, we've broken this wedge formation to the downside. We did have a retest of the breakout. We've moved lower. Very volatile. The spikes can be seen in both directions. If we go to this time frame, or this first time frame I should say, it's the dollar index daily chart. Here we believed that we're forming a bearish head and shoulders. So this being the head, left shoulder, and then the right shoulder here, in fact, broke the trend line or the neckline to the downside. But for the last 2 days of last week, we have seen some upside movement. And obviously, technical analysis is a science. Is an art, not a science. So sometimes when we see these formations, we have to rethink basically what's going on. And if we look to this view on the daily chart, we can see an Elliott wave pattern, so 1, 2, 3, 4, and then down in 5. And if we just close this up a little bit, we can also see that this is a previous area of support, a very strong area of support, and then we've got this area of resistance. So what we could do here is basically move down at the beginning of next week towards this support area. 261.8% is at 93.67, and then potentially bounce higher in a corrective formation to then form a bearish or a larger bearish head and shoulders. So remember, this initial head and shoulders were in this area here, but then we could form a larger head and shoulders, left shoulder here, neckline, up to the head, down to the neckline, up to the right shoulder, and then down again. So the bias for the dollar index, as far as we're concerned, still looks to the downside. We've got no technical indicators, we've got no exhaustion counts, correction counts that would really highlight that this dollar weakness is coming to an end. So we are still looking to sell into dollar strength next week. So going on to the majors, the weekly chart on euro dollar, the bullish engulfing candle posted near the 61.8%. Retracement level, which was at 111.87. Again, very mixed, volatile trading. We did see a break to the upside last week, but the majority of the initial rally has been turned over. If we go to the daily chart, again, this is really what we're looking at from a higher perspective, if you like. Triangle formation breakout, a decent candle as well, posted on the 9th of January, which was last Wednesday. And when we got this retracement down, and we thought that this previous resistance now becomes support, we thought that would hold. We did see a bounce to the upside, but sellers have re-emerged. Now, we're still holding a bullish bias. We're still holding, in fact, a long trade in euro dollar. 114.45 is bespoke support going into next week. So we're looking really for limited selling still in euro dollar. The measured move target for the triangle breakout is 117.75. If we look over here, we've got that spike lower, which is very close to our bespoke support. So again, just reiterating, we're looking for dollar rallies to be limited. So we're obviously looking for euro dollar dips to be limited also. Excuse me. Going on to cable, and obviously the highest volatility pair, if you like, going into next week. Right, there's 4 factors here, and it's very hard, obviously, to predict where we think these currency pairs are going to go when we have these very large news bombs, if you like. But there's 3 different time frames on sterling dollar that highlight that we should go higher, and I'm going to break them down and basically highlight or talk to you about them. Now here we've got the monthly chart. This has shown a perfected 9 as far as DMARC is concerned. Now perfected 9 highlights that you should see at least a correction to the upside within 1 to 4 candles. If price action in sterling dollar stays around current levels, then we will post a bullish outside candle on the monthly chart. So that's the first time frame. Second time frame is we've got a bullish engulfing candle near the 78.6% pullback level, and we've also seen a continued move to the upside. So that again, that's quite positive for sterling dollar. If we go to this time frame, this is the daily chart. This mixed and volatile trading has formed an expanding wedge formation. They have a bias to break to the upside. So, the measured move target is around about 133, the figure. So again, maybe this is going to show something similar to sterling dollar, euro dollar, in the fact that we might get a left shoulder here, a head, move up to the wedge target, and then potentially move lower again. We're trying to forward think, obviously, where we're looking at it to go, not just in the days ahead, but also in the weeks ahead. Support going into early next week is at 127.90, and basically that's where we'll be looking for intraday longs. It is high risk, but it's also quite decent risk reward for taking sterling dollar longs next week. Dollar Swiss, mixed volatile trading on the weekly chart, looks like a wedge formation. The wedge formation does have a bias to break to the downside, although we've held on to trendline support, an inverted hammer at the top. This formation still has a bias to break lower. Now we are short in dollar Swiss. We have moved our stop lower to lock in some profit. If we go to this time frame, and again, it wasn't really an impulsive move to the downside. This was quite impulsive, and then consolidation, and then quite mixed trading. We have reacted higher at the 161.8% extension level, which is at 97.73. We've posted a bullish outside candle on the weekly chart. Now that normally highlights that the sell-off is coming to an end. What I should also mention is that this isn't the strongest pair to play dollar weakness, and in fact at the moment we're suggesting long trades in sterling Swiss and euro Swiss, so that would maybe indicate that we're going to see some sideward movement in dollar Swiss. However, we have got bespoke resistance at 98.54. That level did hold on Friday, so we're really going to monitor this pair quite closely. What we do like is the fact that the 261.8% extension level is down here at 95.53, and that's very close to the previous swing low, which was the 21st of September 2018. Dollar yen, a 261.8% extension at 106.13. If we look to this time frame, which is a monthly time frame, we're still looking for a stronger move to the downside. This looks like a corrective channel. The trendline support has held for now, but with the charts posting lower lows and lower highs, we're still looking for continued losses. And in fact, our bespoke resistance going into this week is at 109.44, so we're looking for limited upside pressure in dollar yen, at least into this week, if not further beyond. Dollar CAD, again we had on this time frame, let's go down to the weekly chart first actually, bearish outside candle on the weekly chart, close to the 61.8% pullback level at 136.85. And we've seen some continued selling. We don't expect this to continue at the beginning of next week. If we look to the 3-hour chart, we've overextended. We've gone through the 423.6% extension at 132.60, and then we've seen a double bottom. We've also seen a break of the previous swing high, so that double bottom is now deemed to be in place. We've got previous swing high at 133.22. I think the corrective extension could go a little bit further than that, and in fact, if we look to this time frame, the daily time frame, inside our army, and then a bullish outside candle. Now, as far as bespoke support and resistance is concerned, we've got resistance at 134.03. That's very close to an area which was quite pivotal going back to the latter end of last year. And then to the downside, we've got bespoke support at 130.93. So we will be range playing dollar CAD going into this week, but we're expecting that upside correction to be limited, and we would actually prefer to be short on a medium-term basis than to be long. Aussie dollar, let's go to this time frame first. Excuse me. Elliott wave formation to the downside completes below the wedge target, which was around about 68.31. We posted a bullish engulfing candle, and we've continued to move to the upside. There's no clear indication really in this time frame that the rally is coming to an end. We've got bespoke support located at 71.20 next week. If we go to this time frame, and again, 5 waves to the downside. This is the daily chart for that last wave lower, a morning star formation, and then this continuous move to the upside. We've got some bespoke resistance at 73.70. Like I said, bespoke support at 71.20. So I think what might happen here is we might continue to the upside. The immediate bias is to buy into dips. So continue to move to the upside towards this level, and then potentially form that reverse head and shoulders again. So moving higher, this being the neckline, then moving lower to make a right shoulder, this obviously being the left shoulder. So the bias at the moment is to the upside, but probably going to be limited to that area of 73.70, 74 the figure. Euro sterling, and again we've got the Bank of England, or not Bank of England, we've got the parliamentary vote on Tuesday. Expect high volatility. Even though we have been medium-term bears for some time and trying to sell this cross up towards 91.30, we have seen 2 weeks of, or even more than that, 5 weeks of rallies being sold in euro sterling. 89.15 is our support, which is just below Friday's low. So really at the moment, intraday calls are probably going to be, or at least on Monday, into selling into rallies. But I think Tuesday's call is going to be extremely difficult, to say the least. And we prefer over a medium-term bias or basis to get short around about 91.30. Don't really want to be buying dips. Euro yen, a few things here. We had a hammer bottom on the daily chart. If we go to the weekly chart, the 61.8% pullback level at 120.01 held very well. To the upside, we've got some resistance at 125.25, which is again not too much higher than last week's high. We've got an inside Harami candle, but that's not surprising after such an aggressive sell-off the week previously. And then basically what we will be looking for, we're looking for at least a first wave completion, and then we'll be looking to fib levels to obviously buy into dips on an intraday basis to the downside. Okay, I hope you found that informative. We'll be back again next week with some more analysis. Thank you very much.